on. So welcome everybody. This is Multifamily Passive Cash Flow for Life. We meet the fourth Wednesday of every month, either virtually or live. And when we're live, we're at the Timbuktu restaurant about 10 minutes outside of Columbia, Maryland in Hanover. We were on virtual for a long time during COVID. And then we tried to go live again about 4 months ago, maybe 5 months ago, had a couple of live presentations, and then the new variant showed up. So we're now back to virtual. So hopefully everyone's okay with that. Virtual is great because we get a lot of people from all over the country. In person is great because obviously you get to interact and network with a lot of people. So it's fun both ways. So let me make sure I can admit everybody here. So my name is James Ray. I'm going to be your host tonight. This meetup, as you can tell by the title, is all about apartment buildings, mobile home parks, and self-storage. The fourth Wednesday of every month, we bring in a speaker to do a presentation on a subject that hopefully will help you grow your business, or if you want to learn how to invest passively. Either way, we hope that we can actually provide value for you. My partner, Nicole, who's on as well, has thousands of units across the US, has been invested in commercial real estate for the past 25 years, and she's going to be helping host as well. Nicole has also put together a phenomenal multifamily class that is now online. You can find it at passivecashflowforlife.net or .com, either one works. It's a phenomenal one filled with 25 years worth of experience, and we've got a lot of great feedback on it. So if you have an interest in going to the next step, feel free to go to that website. Nicole, are you there? You want to say hi?
Hi, everybody. I really appreciate you coming, and hopefully you're going to get a lot out of this. There's just, with COVID, there's just a lot of changes in the markets and in what is being funded. And so we wanted to bring some of the most current news to you.
Absolutely. So, all right. So a couple of housekeeping notes. We're going to be doing Q&A throughout the presentation. So if you have a question, just put it in the chat box. I'll be watching that. If you're on Facebook, you can actually type it in there as well. We've got somebody monitoring that, and she'll send me your questions as they come in. And then if there's a lot of questions and we need to, obviously we will do a Q&A at the end. We'll hold on to Terry for as long as he's available. All right, so we're going to be posting a replay of this on the YouTube channel and on Facebook page, which is Multifamily Passive Cash Flow for Life. There's also a private Facebook group if you have an interest in that, kind of the same thing. You just look up under group. What else? Let's see. We're going to edit this over the next couple of days. We'll put it out. And then if you're on our mailing list or you're on meetup.com, we'll send a link to the recording from our YouTube page as well. So as Nicole mentioned, a lot has changed over the last 2 years in multifamily financing, not just everything else, but a lot of stuff has changed. So to go over some of those changes and what the multifamily lending space looks like, and to answer all your financing questions tonight, we have Terry Painter. Terry is the founder of apartmentloanstore.com and businessloanstore.com, a commercial mortgage banking and advisory firm that has closed over $4 billion in commercial loans in 1997. For 18 years, Terry has spoken nationally to commercial real estate investor groups, real estate brokers, and banks about commercial real estate investing and lending. Terry is a member of the nationally recognized Mortgage Bankers Association. He's a regular contributor to Forbes Magazine. He's got some great articles on there if you have a chance to actually go look at it. He's part of the Forbes Council. And he's also the author of the Encyclopedia of Commercial Real Estate Advice, which you can find on Amazon. So Terry, I'm going to let you introduce yourself, and then we'll get started.
Hey, thanks so much, James. It is so good to be here. Boy, I'll tell you, things are kind of crazy in your neck of the woods. In fact, until we get to like South Carolina, prices, where prices are still somewhat sensible. There's not a lot of properties there, but I'll tell you, it's really something, because we do lending. We're mortgage bankers, commercial mortgage bankers, and commercial mortgage brokers, and we do loans in all 50 states, actually. So it used to be that there were always places to buy, places not to buy. And in the 25 years I have been lending commercially, I have never seen anything like the market we have today. And also, you mentioned, what I'd like to talk about. I want everybody tonight to get a more cozy feeling about where lenders are today, what they feel comfortable with, what their hotspots are, what it takes to actually get approved for a commercial loan. All commercial loans have the exact same 7 pre-qualifications, and it would be great to know what those are. And it's really important these days to qualify both the property and yourself whenever you apply for a loan. So there you go.
All right, awesome. Well, thanks so much. So I guess I got a couple of subjects that you and I kind of went over, and then some other questions, and then questions as people come on. So I guess right off the bat, you mentioned a little bit of it. Can you expound maybe a little bit on what's going on in multifamily real estate right now? Are we at the top of the market? Are there still deals out there? Can you talk a little bit about that?
Certainly. Okay. Well, as everybody's aware of, what created the incredibly high prices in residential homes, since 2020 has actually been just a shortage of homes being put on the market. So that's one dynamic. Okay. However, in the commercial real estate space, property values should always be constrained by the net operating income and by what rents are, in each market. And one of my favorite sayings is that commercial properties are like an elevator. So James, you've got to ask me, like, well, how are commercial properties like an elevator?
How are commercial properties like an elevator?
Okay, here's the answer. They go up and down, and they have a top floor. Why? And the top floor is the thing that we have to really look at today, especially after the stock market just recently tanked quite a bit, very recently. And because we had a lot of overvalued stocks that were not based on reality, but based upon the whims of investors buying and selling, and mostly, buying, trying to get in while prices were good and so on. But they were not necessarily based upon what these companies were earning. And so what's also happening in commercial real estate, and we could, I'm going to aim this conversation tonight more towards multifamily apartment buildings. But what's happening in that sector is just that there is also a lot of people buying and very few properties on the market. And so there's also people who have 1031 money that they've sold their properties and they have to buy something. And so that's money that they mostly earned a lot of it from appreciation. They didn't have to work hard for it, really. And so they can actually take their equities from years and years and years and actually afford to buy a more expensive property today and come out okay. So, but what's happened is that we do have overpriced properties today. And I do want to address, it's really hard to know whether we're at the top of the market or not, because I'll tell you one thing is we're still seeing, on the Eastern Seaboard and throughout most of the country, we are seeing just that there's just not very many apartment building starts. That's a long, lengthy process. And that is one of the factors that is keeping supply really low. And there are some, so there are some good buys, but you've got to really look for them. And if you're going to be looking like in the Baltimore area, for instance, where I think you might be based, James, the properties that are, certainly below, let's just say a 6.5 cap are in pretty, they're just need a lot of work. They're old, worn out. And so it is a time when, if you are going to buy a property, if there was ever a time to do it intelligently, it is now. You've really got to know who you are going to be getting married to.
And you talked a little bit about starts. So do you mean new construction? So there's no new construction. So the value of the apartment buildings, because there's less supply, is going up. Am I following that right?
Yes, I'm sorry. Yeah, exactly. New apartment starts, ground up construction.
Okay.
There's some opportunities in some places still to do rehab, but the prices that they're asking for these properties that need rehab just don't pencil. They're expensive too. So.
All right. So somebody, I still see people buying, and I know some people are overpaying. Some people are getting good deals. And to your point, you really have to dig, but that's been true, for a long time. If you want to really want to buy, you underwrite conservatively, you stay safe to make sure that if there's a downturn, you stay safe and you don't lose your investment, if you will. what can people do to kind of purchase intelligently? What do you recommend to people that bring their deals to you and say, hey, you know something, is this deal work? What can they do?
Okay. Well, the first thing is to actually start out with doing really thorough due diligence. What we're seeing is a lot of real estate professionals, not all, selling on pro forma, selling not based on actual, but based upon the property's potential. And I used to do one of my companies is called Business Loan Store, and we've done hundreds of business loans in that company. And if somebody came to me and said they wanted to borrow money for a business based on what it was could be, making a year from now, but right now it wasn't doing that well. It couldn't afford that size loan, or it wasn't worth that price. We would just laugh at them, tell them to go somewhere else. But in some cases, that's what's actually happening. So it's really important to actually get the financials and really pour through them, and also, walk every unit if it's a multifamily purchase, and get a good idea of what the condition of the property is in. So you really want to know what you're buying. Does that make sense?
No, absolutely. So, so in terms of lenders, you referenced a little bit earlier, we have people at all levels that are part of this group. People that are just starting out, have never done anything with real estate. We've got some people that have been very successful with single family and are now looking to jump into the multifamily space to accelerate their wealth, if you will. And we have people that have been in the multifamily space for a while and are continuing to grow. So overall, what pre-qualifications are lenders looking for today to be able to give a loan? And obviously, they want to feel comfortable giving you their money. So what are they looking for? What's important?
Okay, so all commercial lenders really go through 7 pre-qualifications. Prior to the Great Recession of 2008, just about all commercial lenders really looked, what was number one of the 7 pre-qualifications was the net operating income of the property, the income. Okay. But, today it's the borrower, because it was, the subprime market and all the shenanigans that went on with that, with making loans to people that they couldn't afford, that actually caused the crash. And so today the borrower is still the number one focus. So the borrowers we're talking about, actually lenders today are looking for, and in this session tonight, I'm going to go over some of the main types of loans that we do. We do just about everything. And so you could kind of, we'll talk about where it's best to get started, and, what you could do if you have a larger property, a smaller property, and so on. But anyway, as far as qualifying, okay, so community banks are actually, and credit unions are actually the easiest to qualify for, but they do not, but like in your neck of the woods, they have shorter amortizations, which make the payment, more higher. Certainly in where our head office is in Portland, Oregon, I could get you a 25 or 30 year amortization easily at most community banks. So, but community banks do not have this really hard and stone net worth requirement, which a lot like agency lenders like Fannie Mae, Freddie Mac, and so on do have. So, and all securitized loan programs have. So it's easier to get started with a community bank, but their hot button is actually, as far as the borrower goes, is your income, because they're regulated and they have their file, the regulators go into their files about every 6 months, and they cannot make a loan to you unless you pretty much today have like 2 sources of income that's verifiable on tax returns. Okay, well, somebody who's self-employed who doesn't want to show much money on tax returns, or just doesn't, we have, for larger loans over $1 million, we have programs that don't collect tax returns but have very good rates. So, but anyway, we have the quality of the borrower, which also entails experience. Now, if somebody has owned a bunch of 1 or more single family homes, then great. It's the same thing, really, getting it to multifamily, which is by definition 5 units or more. It's just that, so community banks are fine with you making that leap. Credit unions as well. They don't require you to have credit unions, and community banks don't require you to have a lot of post-closing liquidity, which is great. So the borrower is one of the 7 pre-qualifications. Another one is just the location of the property. And all lenders, this has always been, they really don't want to make a loan, obviously, in a bad neighborhood. There are certainly hard money lenders that will do that. But, good quality lenders with great rates, that's not their favorite thing. So we usually pull like a crime report in, most neighborhoods that if we're in larger cities, if we're not really that familiar with the market. And a lot of lenders do that. So we have the quality of the neighborhood. Is this a large market or is it something rural? If we're talking about, let's just say, Los Angeles, and surrounding area of over 12 million people, well, that's one market. But then there's some towns that are just like 40 miles out that have populations of under 10,000. So the quality of the location is really important to lenders. Now we're going to go into the property's income. So that is really, with the higher prices now, what's happened is that rents are really behind because of COVID. Rents really went flat, and initially, and then what happened is that actually rents as of October of 2021 annually actually increased 10%. And so that was amazing because they usually increase an average of 5 or 6%. And on the Eastern Seaboard in the larger cities, we've seen, like in New York City, and we've seen rents go up 14%. So that's really good because as long as rents are going up, property values go up. But there's kind of so as far as like the property's income though, is that properties are priced at a place now where somebody who could put, let's say 25% down or even 20% down on a property today has to put 30% down or even more because the net operating income does not cash flow a 75% loan these days. So we have the debt service coverage ratio, still on multifamily is about 1.25, and some community banks, getting back to what's great, one advantage of working through an experienced mortgage broker commercial mortgage broker is that they know these numbers, they know these metrics. They know, for instance, that community banks really stress out interest rates to, let's just say if they make a loan to you today at 4.25%, what they're going to do is they're going to stress that rate for underwriting purposes. They're going to underwrite it at 6%. Why? Because their loan's probably going to mature in 5 or 10 years. And when it does, they want to make sure you could, if rates are at 6%, that you could still get a loan. So anyway, so the property's income and debt service coverage ratio are all very important. It just takes more cash now to get into a property, unless you could get owner financing. Property condition is always a hot button for lenders. If it's just, and right now, because the properties that need more work, there's just like on the Eastern Seaboard, there's not a lot of fixer-uppers left. And the properties in the multifamily sector that need more work they're just priced too high. And the seller could just wait and get those prices. So it's not really a good time to buy a property that needs major rehab or a lot of work or unit configuration. Just as far as, value adds, in my book, I go over repositioning. There's a couple of chapters on that. And what you want to do is, of course, find properties that have rents that are below market, and also that perhaps need some new floor coverings, some new window coverings. The cabinets could use a coat of paint, new landscaping, perhaps. Just gingerbread up the place, but don't spend a lot of money on it because you're going to be paying too much just for the property itself. So that's the condition of the property. The next, the fifth pre-qualification is the occupancy of the property. And so community banks can pretty much make a loan on a property that's 85% if there's a good story behind it. Like you've been, turning units, let's just say it's just, the property's been gone through a lot of major rehab or something. There's a good reason for it. But however, a lot of lenders really today are looking for 90% occupancy or above. And we're in an unprecedented market where we're seeing occupancy. There's hardly any place like on the East Coast that has occupancy lower than, I should say, vacancy, higher than 3%. So it's a really solid time to buy property. They're just too darn expensive. Okay, so another pre-qualification, this is for all commercial properties, is tenant quality. So since COVID and the problem we're having with blue collar workers that are making less than $15 an hour or less, is a lot of them in blue collar neighborhoods, working class neighborhoods, we're not paying the rent. So that's really so the quality of the tenant, we're really looking for these days for really a good history of tenants that are on the rent roll, that are paying rent. Just when you're buying a property, just because somebody's on the rent roll, it does not necessarily mean they're paying rent or they're paying it on time. So that's really something that we really dig into. All lenders are doing that. We're looking at one of the things, this is something that we've always recommended, and that's to do a rent collection report where you're going to get 12 months of rent rolls. Okay, so a lot of sellers are going to say, hey, wait a minute, this is a seller's market. I don't need to do that. But it's really important. If you get 12 months of rent rolls, you then want to compare them against a 12 trailing month report that shows, income and expenses. And from that, you're going to be able to tell pretty much whether the units are, who's paying rent. What we call economic occupancy. That's what we make the loan on today, is the economic occupancy. Does that make sense?
No, absolutely. No, it does. Were those the 7? Or was there another one?
There's one more, and that's
Okay.
lease quality. So in some markets, it's okay to have some month-to-month leases, but certainly we don't have to really worry on multifamily about like when retail, office, and other multifamily products, there's tenant rollover risk. We don't really have that with multifamily because you could you could make ready an apartment in a week or two. And so, but what we do have, but still, lenders like to see the majority of the tenants on 1-year leases. And so at a minimum, I'd say 6-month leases, but you could have some month-to-months for sure. So that's it. So we're talking about lease quality. If we're talking about office, retail, or industrial properties, then we're looking for 2 years or 3 years or longer remaining on the leases. So,
okay. So it's interesting about the community banks because I had heard recently, actually, I know that agencies, so like Fannie Mae and Freddie Mac, you've got to have a net worth equal to the value of the loan.
correct.
And it doesn't have to be just you. It can be you and 3 or 4 partners or whatever it is, depending on the size of the loan. Obviously, the bigger the loan, the more net worth someone has to have to be able to actually get the loan. So in terms of community banks, you mentioned that they're not as focused on the net worth equaling the loan, but you also mentioned that they're looking at your income. So I guess my question is, if I go to, I don't know, People's Bank, which is a local bank, for a local portfolio lender, and I come to them and I say, listen, I've got a 20-unit apartment building that I want to buy, and it's, $2 million. So maybe off the top of your head what a mortgage payment would be, but let's say I have no idea. I'd have to look down on what is it?
I don't know.
Okay.
Yeah.
Let's say it's $20,000 a month. Okay. I have no idea. I'd have to actually get my calculator out and figure it out. But let's say it's $20,000 a month. Most people's income, if you have a job, and even if you have a second job, is not going to be $20,000 a month, right? Mm-hmm. For most apartment buildings, your income, what you bring home on your W-2, is not going to be enough to cover the mortgage payment on a multifamily. So why are they looking at your income? I don't quite understand that.
Okay. So, number one, all banks are required by the feds to do a global ratio, which is actually for each borrower, or what we call key principals that own the property that are going to sign on the loan. What we're looking in is all cash out for those individuals, cash out and cash in. And then, it's not just like when you buy a home, they do a ratio just based upon your income, your debt to income ratio. But in this case, they're taking a look at all of your debt, all of your income. And so they're taking it, that's separate than taking a look at the financial solvency and strength of the borrower is totally different than the property. The property, even for community bank, stands on its own, and they're going to be taking a look at for the property, net operating cash flow, but not only that, but the historical cash flow. They're going to be taking a look at, as I mentioned, rent collections and so on. And if that's making their debt service coverage ratio, and it's not something where they just for the last 3 months, somebody's selling the property and they filled it with tenants that they didn't screen very well, but it has historical, showing the tenants have been on the rent roll for quite a while, then we're good to go for a community bank. But you see, Fannie Mae, you mentioned, and Freddie Mac, agency loans, they do not do a global ratio. What they do is they just do, they'll take a look at all of your income properties and make sure that they have positive net cash flow. But other than that, but a community bank has to do what's called a global ratio, which is taking a look at your personal income and business income against all your personal debt and business debt. You come up with one number. And so let's just say for every, most banks today want to see like maybe they do a 1 to 4, 1 to 3, some goes to lows of 1.25, but they want to see for every dollar, dollar of income that you have after paying your debts, that you have 30 cents left over. So that's one stress test for a community bank. But what they don't have is this really rigid net worth to income ratio, and also like Fannie Mae, Freddie Mac, insurance money, Wall Street money, CMBS, all that. That's all part of our world. What they're looking for is post-closing liquidity, and larger banks, larger banks like Chase, and Bank of America and so on, actually want to see like at least probably 10 to 15% cash in the bank when you close your loan. But no lender, even hard money lenders today, are going to want to see you be, if you're buying a property, that you're going to be broke after closing.
So it's I know with the agencies, I guess it's 10% liquidity based on the loan. So if you buy a $4
actually,
million
the agencies today are asking for 12 months of loan payments. It's pretty cut and dry.
Oh, is it? Okay. All right. So it's different now.
Yeah. 12 months of loan payments. Yeah.
Right. Okay, great. And then in terms of small loans versus large loans, what if I'm someone that is getting started and I want to buy a 10 unit? That's kind of my first thing. What are options? Do I really go to a community bank, or can I get like a Freddie Mac loan, or where do I go?
Okay, well, okay. So keep in mind that commercial and it's kind of an elitist group. I hate to say that, but it's true from the standpoint, with the exception of community banks, just about every other lending program that has really good rates actually is looking at experience of the borrower. And they want that experience to be in the same type of property. It's crazy, but I'm going to tell you, because I have a lot of my clients, some of them own 5 or 6 or 30 or 40 or over 100 single family homes, but it doesn't necessarily qualify them for all. It's a lot of our, like Fannie Mae, for instance, is going to want you to own 5 units or more under one roof or on one tax lot to qualify for a loan for them. And you're going to have to own a property like that for 2 years to get that. Means so. We obviously in this conversation today, we don't have time to go into the criteria of all these loans. I do have that in my book. I have 18 loan programs, and it has all the qualifying criteria and lending criteria. So, but getting back to where you want to get started, actually, what's good about a community bank is that by chance, if you do have, if you do find a property that's, let's say 10 units and it's cash flowing brilliantly, in other words, and you could put enough down, maybe you're going to have to put 30% down today to get that loan. A community bank could also put a second on your house and make, and qualify for, make the federal regulators happy. So they have some flexibility there. So community bank or credit union is probably the best place to go if you don't have experience, because they're going to be looking at the property and also your credit score. You're going to need to have a score of probably around 700 or higher. For a lot of our other loan programs, including the agency loans that we spoke of, Fannie Mae, Freddie Mac, you have to have about a 680 credit score. So, but good for community bank, good credit, good income. If you have, if husband and wife both work, all the better. If you have a rental property income, all the better. Then you could get your foot in the door, and then you have a solid property that has good history. It doesn't need a lot of work. It's just like, that's where you want to get started. It's like, if you're going to get started with a fixer upper that needs quite a bit of work, you might have to get owner carry financing and pay more for the property in exchange today.
Okay. And what about, you hear a lot about bridge loans. Can you talk a little bit about those?
Certainly. Yeah. So a bridge loan, for those of you who are not familiar with what a bridge loan does, it's exactly what it says. It's a bridge from one loan program to another. For instance, if you buy a property today that needs some work, and let's just say the property is over 1.5 million in price, and what's going to happen is that you're going to the property is not, let's just say it's not going to cash flow the size loan that you want. So it's really great. So what you're going to do is you're going to take out a bridge loan at a higher rate of interest, but it's going to be interest only. So it's not going to be as painful as you might think. But you're going to take out a bridge loan, and then once the property gets stabilized and it gets you rent it up at today's rental prices and improve it, or even increase the rents a lot, then you could go ahead and apply for a conventional loan or an agency loan or something like that. So it's a bridge loan. We're also, I have one of my specialties is doing syndication financing, and that's for syndicated groups that raise investors. And sometimes they buy properties from a bridge lender just because they're not going to qualify from one of my other programs. And we'll do a bridge loan for them, because what we can do is I can make a bridge loan today based upon what the property is going to be worth if it has under market rents today, and if they're going to just fix it up a bit. So if you buy a property and you could show me that that based upon properties in that area that don't have those amenities, that are in that condition, that they are getting these rents, then I can make you a loan. I can make you that higher loan once you get the property stabilized at those higher rents. So bridge loans come in for that purpose as well.
So that's great. So I've heard a lot about bridge loans lately. I guess that seems to
I just want to tell you also, community banks are really good at, they're not going to they hate interest only. They'll never do it, but they're really good at, and they don't like cash out, by the way, much either, if you're going to be doing a refinance, but they're really great for, they know the area. This is their own backyard. They know that what the potential of those properties are. And if you go there with a really solid business plan and show them that you're going to be doing this and this and this, and based upon these properties that you could get those rents, they'll be happy to work with you. They could do what's equivalent to a bridge loan, but they'll do the perm loan right out of the gate. It's just that they're restricted to only lend you based upon what the net operating income is today, not what it's going to be later, which is what we could do on a bridge loan. So there you go. I just want to also bring in that, since we're talking about community banks, that it's really important to not just talk to the loan officer, unless it's somebody you've really worked for a long time, but make sure that the loan officer really runs this project exactly what you want to do, especially if it's got some fixer-upper components, by whoever approves the loan, because right now in the bank world and community banks, it's just there's still a lot of uncertainty because of COVID and what they've went through with rent collections and so on. So it's really, sometimes what we're seeing a lot of is just some bank officers that are over-promising and then under-delivering. So just watch out for that one.
Okay.
But yeah.
All right. Well, I guess that's where a good mortgage broker comes in, right? You can kind of shop your deal around and come up with
could do that
kind of
for you.
solutions.
Yeah.
Okay. And then for a bridge loan, can you get financing for the rehab as well, or it's just for the property?
Yeah, actually, bridge loans, good question. Bridge loans actually start with the purchase price, then they add the closing costs, then they add on the cost of the renovations. And then they will lend you, they'll take a look at lending you, they have like a loan to cost, which might be as high as 80% of that number. And then they'll take, and then what we can do, because we do the community bank, we do the perm loans too, is that we know that we could then do, let's say, a 75% loan based upon in 18 months to 2 years. And then based on that, we could, bridge lenders can make perhaps a larger loan then, but it's going to be constrained by a loan to cost and also a loan to value based upon what the property will be worth once the improvements are done.
Okay, so for some of the newer people on here, there's something called a DCR, which is a debt coverage ratio, which a lot of banks use. And what that basically means is that for every dollar that you bring in after you pay for expenses, they want you to have at least $1.20 to be able to pay off your mortgage. They don't want you to just have just enough to pay the mortgage. They want you to have enough to pay the mortgage plus 20 to 25% more.
That's
so I guess
correct.
my question is, for the bridge loans, where does the DCR fall? Is it still at 1.25 in general, or because of the bridge loans at less?
Bridge lenders are really smart people, and because they understand, they know that they don't actually, what they're going to do is a debt service coverage ratio and see where it is right now. But let's just say it's at a 1.10 right now. But you could show them that the rents are under market today, and with these improvements, you're going to be adding $150 a month onto the rents. And from that figure, they'll trim it down a bit, but they're going to be doing their debt service coverage ratio based on what the perm loan might look like to take them out. And they don't actually have a solid, in stone debt service coverage ratio, which is an advantage.
Okay.
Well, a bank pretty much has to. So a bank is going to be making you, if they do a 1.25 debt service coverage ratio, and you have to do work on the property to bring the rents up, they're only going to lend you, as I mentioned before, what the property could pay for today.
Okay, so if I understand, there's different buckets, right? So there's community banks, local banks, credit unions. There's the agencies, Fannie Mae and Freddie Mac, and then there are separate bridge loan lenders.
Yeah, there's bridge loans and larger. I do want to address your question also about where to go for larger loans. Well, okay, so in our world, like right now, we took out a $27 million construction loan that we did with a perm loan. We do really large loans. What we also do, we do loans, we'll do a loan down to $750,000 because some of our best customers have grown from when we did loans for under $200,000 at one time. Now they're the big guys. And so, we don't really have funding available for programs much under 750 or under $1 million. So, but there's plenty of money available for that. But bridge lenders, going back to, okay. So I'm sorry. So for loans under $1 million, you're pretty much going to be looking at community banks today, or credit unions
for under $1 million.
Yeah, for under $1 million.
Okay.
I would say, that's just pretty much solid. If you're going to be getting, let's say, when you start getting, let's say over 5 million, then what happens is or over 10 million, it's a different world up there. And in that case, you could get bridge loans that are priced quite low, where for somebody who needs a bridge loan on a property that they're buying at, let's say, 700,000, and the loan's going to be 525,000, let's say, that loan's going to probably be at 8 to 10% today on bridge money,
right?
Interest only. But some of our larger loan programs starting at 5 million, the rates are considerably lower. We're talking about 5.5, 4.75, 7%. It's going to be better. Yeah.
Okay. So for those small loans, it kind of sounds like a soft, hard money lender.
Yeah.
Right.
Yeah. But I do want to bring out, there's one really great opportunity today. Just keep in mind that, larger, is a bit better. If you could, if you could work it out to find a property where you need to borrow at least $1 million and the property will cash flow that, our Freddie Mac loans actually will, that's one of the, they have great rates today. And we're talking about like maybe under 4%, 3.5%, 4%. Of course, rates just went up this last week. But anyway, they have 30-year amortizations. We could sometimes get you a couple of years of interest-only payments, and you don't need experience. So, I mean, if you have a rental property, that's fine, but you don't have to have owned an apartment building prior. So that's a really good way to get yourself into the, into the big boy, big girl world sooner. It might mean that you have to take on a partner, and just keep in mind that could be like being in a marriage. It could be good or it could be not good.
Right.
And so it's better if you could just take on, if you're going to take on a partner, for heaven's sake, make sure you're the controlling, you're the managing partner, and ideally make sure that you own over 51%, so you could call the final shots. Okay.
Right. No, that's great advice. I know that we've had several students that have gotten together and become partners and kind of grown from there. They started off really small, but they found a broker that kind of believed in them, and now they own very large apartment buildings. So good for you guys for kind of
Sure.
planting that seed to be able to grow with individuals. So for this Freddie Mac program, which sounds pretty interesting, they don't do loan to cost though, right? That's only loan to value. You're not going to get any of the rehab money from Freddie Mac.
Actually, we don't call it rehab because it's not for rehab.
Okay.
But you can, probably maybe like around $7,500 per unit. If you could just keep it within that, then that's fine with whatever renovations you need. We could add that on to the cost.
So if I have, and I'm just keeping it very, very simple, right? So I've got the units in the Baltimore area, about $100,000, right? So I find a 12 unit, right? So I can get $1 million loans that works at 1.2, and I need, I don't know, 10,000. Well, no, we do $5,000 per unit, right? So I need $60,000 worth of renovation money. Can I go get a loan for 80% of the $1 million and 80% of the rehab money, or only 80% of the cost of the building?
Okay, so first of all, sorry that this is complicated, but commercial lending just is.
Sure.
And but okay, so if we're talking about somebody who doesn't have experience, then they better stick at 70. The best they're going to probably get is 75%. But with Freddie Mac also, they go up to 80%, but they have tiers. And so for a very small market, they're only going to lend up to 65%. For a medium-sized market, 70 to 70%, 75, and then up to 80% for a large market. So that's we do have some constraints in there. It's pretty difficult. We're just not seeing properties that are going to cash flow an 80% loan right now, even though Freddie Mac does goes up to 80% for sure.
Okay. So it sounds like for a lot of these guys, if they wanted to get a Freddie Mac loan or something like that, they would have to find a partner with a net worth.
Yes, if you don't have the net worth, or you don't have because you do have to have a net worth at least equal to the size of the loan, and 12 months of mortgage payment in the bank when you close.
Right.
Post-closing liquidity is what we call it. That's really important. So.
Okay. And it's interesting about the whole partner thing, because I think it's very important. You probably tell people this as well, to put it all in writing. Everything's great and everything's, sunshine and roses when you first start off. But if something goes wrong, you want something in writing between you and your partner in terms of who's going to be responsible for what, who's going to pay for what, all of the different circumstances that can occur.
Yeah. It's almost like you've got to get a prenup with each other, each of you. It's kind of like, yeah, exactly. But having it in writing, because I work on a lot of syndicated transactions, which are regulated by the SEC, and they have what's called a private placement memorandum. Everything is spelled out so clearly. I love those because you can't just take in a partner and give them a rate of return of, let's say, 6%, and then give your sister 10%, in that same class. I mean, everybody follows the same rules, and it's very spelled out, and you have a fiduciary responsibility to take care of your partners. But as far as but if you're going to just do it small, just get an LLC to own the property. And as long as your partner is going to be having some, involvement with the property, then then they're not going to be, you can't call them a passive investor, but then you just take them on but do write everything up, have an attorney do it. Sorry, it's going to be expensive, but you better do that, as James is recommending. I'm going to tell you that I have actually, on businesses and commercial real estate properties, investment properties, we have the divorces where people have split up have sometimes been very nasty, and you don't want to. So if it's in writing, that doesn't happen that often, but when it does happen, we have in other words, we have to do loans sometimes, where one partner has to buy the other partner out because they hate each other. Yeah.
Right. Well, I think one thing to remember also is that you can partner just on one deal. It doesn't mean that if you partner with somebody, you're going to be stuck with them for the next 50 deals or whatever it is. You can do one deal at a time, and if it works out, maybe do a second deal. If it doesn't work out,
yeah, exactly.
You got something in writing, move on to somebody else, kind of thing.
Yeah.
You talked a little bit about interest only. And obviously the advantage to interest only is that your payments are lower. So when you're doing your renovations and maybe you have a little bit higher vacancy, you can still cover your payments. What are some disadvantages or are there any disadvantages for interest only loans?
Well, obviously, if you're going to take Freddie Mac at 65% can make interest to somebody who has a bit of experience, can make an interest only loan for 10 years. But you're not paying in that 10-year period, you're not paying off anything on principal. So that's the main disadvantage. So what happens, but if it's an apartment building, if you take a look at going back to like the 1880s in America, property values, even though they've always had dips, have ultimately always gone up.
Right.
Within a 2-year window, they've always gone up again. And so that's really, so really you're going to be making more money from appreciation than anything else.
Right.
So, yeah.
Okay.
Yeah.
Go ahead. No, please go ahead.
Just one thing else I wanted to address, and that's that we are making today to experienced multifamily investors that I do have clients that are buying overpriced properties. However, they know the rents are under market. They know what they're going, just the small things they're going to do that aren't costly for value adds, and they know it's a good neighborhood. So just keep that in your mind. Good neighborhood. If it's not in a good neighborhood, and also, if it's just like during the coronavirus recession when people when they're getting those subsidies from the government and all this unemployment, and and a lot of people were not paying rent. C+ properties and above in good neighborhoods, everybody was paying the rent. It's just, so the quality of your tenants having better jobs, the C+ properties and above, these tenants have savings. So you don't get yourself into a pickle in the future. Don't just think about today. Recessions happen on average every 6 years. And we just went through this really we're going through a bull market right now, and so prices could fall for a while. They could, and so if you're going to buy today's high prices, you just got to do it intelligently, and it could work out. You're not going to have a lot of income for the first 2 years, very low. You're not going to probably see an 8%, you're not going to see an 8% cash on cash return. You might see a 4% for the first year, a 6% or 8% the second year, if you could raise rents. But by the time you get to your third year, and certainly by year 5, the property is going to grow in value because the rents are going to go up. And that's the one major tenet of commercial investment property, or any investment property for that matter, is that as long as you can raise rents, the value will go up.
Right. Okay. That makes sense. A lot of sellers feel that they're in the driver's seat because it is a seller's market.
Yes.
And sometimes they're pressuring people to close early. On average, how long does it take for a loan to close so that if someone is buying something, they know what to write into the contract? Does it take 30 days, take 90 days, 60 days? Is there an average?
Yeah. Okay. So here's what's happening, because we're doing mostly refinances in our 2 companies right now because not a lot of purchases, but what's happening. Okay. So so you really need 60 days for financing. Okay. A community bank could certainly do it in 45 days. Freddie Mac is taking, towards the end of the year, they were taking more closer to 90 days because not only does the lender have to approve the loan, but then Freddie Mac has to approve it. And there was a long queue. But the problem is that there's that pressure. I'm so glad you brought that up, James. Don't back yourself in the corner, because what happens is that every single time if you don't make that 30-day deadline or 45-day deadline in the financing contingency, and you do need to extend, then you're going to have to put more money down that's going to go hard. And so what happens, you've got to make sure also that you're choosing the right loan program. You don't have time today to make a mistake and choose the wrong loan program and then apply for a second loan. Of course, you could get out of it because of the financing contingency, but then think about all the time you put in trying to find this property, and now you've found it. You really want it, and really, we are seeing financing contingencies that need to be at 60 days being written at 45 days, but that's a bit risky, and 30 days is insane. I'm sorry.
Right. I think also because, I know people that are buying deals, right? So I know the deals are out there. Now, they may look at 100 deals, right, before they find the one. And out of that 100 deals, maybe, they do 10 minutes on 50 of them, but the other 50, they're underwriting and putting out LOIs and stuff like that. So they're out there. I think the danger is that for a lot of the people think that they're supposed to get a deal now. Okay, I've done I've put in 30 offers. I should have an offer. This one's got to be it. And they start massaging the numbers. So the numbers tell them what they want to hear versus actually looking at the numbers and making sure that it's a good deal.
Excuse me for interrupting you, James, but that is subliminally, subconsciously, we're wired for that. Just as when you're dating for the first time and you think, this is the one. You just get that feeling, and it's kind of like this love at first sight, or just even if it's the money you're going to make from the property and the work you're going to do on it, whatever that's driving you. We have a tendency to be more positive when we're first meeting a property. And then what happens is you got to go through the get to know you stage, which is the due diligence. And sometimes it's difficult to let go of your first impressions of the property, just like it is with a person, Right. And as you're saying, you've got to, you want to make sure that that this property can do what you think it's going to do.
Well, it's funny. I tell people that, you don't have to use our underwriting sheet. I think ours is really good, but whatever underwriting sheet you use, make sure you pay attention to it because the numbers don't lie.
Right.
So make sure you're using some kind of underwriting sheet that you're comfortable with to make sure when you look at your properties, you're actually getting a good deal. So we've got some questions here that are people sending in.
Please.
Nicole, you've been quiet the whole time. Do you have questions for Terry?
No, I think he's hit a lot of the points that I think are important. The one thing I might ask is that when I'm seeing deals these days, the ones that seem to make sense economically, they tend to be in tertiary markets that are the outer commute burbs from cities, if you will. And you basically said that that they're harder to get loans for. So my question is, if you're going to kind of weigh them out, that's where the deals seem to be today to me.
Sure.
Any thoughts?
Yeah, I do have a couple of thoughts for you, Nicole, because you're experienced and you own a lot of units. You could always get a Fannie Mae loan, which will do a tertiary market. They prefer, they could do under 10,000 population, and they're great loans if it's a larger loan, or the banks because otherwise, like if you're talking about a lot of but what's good about Fannie Mae also has 30-year amortization, which gives you lower payments, but some of because what's happening is these tertiary markets are not small markets anymore, because the rents are just too high now because rent increases, as we spoke at the beginning of this meeting today, are driving more people to drive to where they live, or work remotely from home. And it's just what's happening today. And, tertiary market is not what it was 2 years ago. And so you could find some good values there. Nicole, you're absolutely right. Community banks nearby would probably be the best source. But if you want to get, better, like I said, if you want to keep the property long-term and fix the rate for 10 years, 30-year amortization, maybe a couple of years of interest only, even, Fannie Mae would be the way to go.
There's also a real lack of rental properties in a lot of these smaller markets. I mean, there just is not enough. And so if I can find a property at an 8 cap in a tertiary market where there just aren't enough rentals, seems to me to be something that we ought to take a serious look at and then try and find financing to support it.
Yeah, it's just that it's just historically what's happened in these smaller markets. Okay, so if it's a really beautiful area and there's a lot of retired people living there, great. But if there's just no jobs, not in that area, and then that's historically that's what really scares lenders and underwriters. It's just exactly that. That's why they like bigger cities.
Mm-hmm.
So just keep in mind that just as if you really want to, if you find a building where even though the rents are under market, there's a bunch of older people, even if they're on Section 8. I'll tell you what, people on Section 8 always pay the rent. Usually they don't want to lose their vouchers, but especially seniors. You could find a place that has more older people, living in that apartment complex. That they have a tendency to take better care of it. And in a tertiary market, they can have retirement income, Social Security, and it could be a really good investment for you, Nicole.
Do you think that with the change in working from home, that a lot of people are predicting to be more permanent than not, that some of that may change in terms of not having such a pressure on not having jobs in smaller communities?
Yeah, I think that's we just like we see changes, like there's no more 1-hour photos, no more video stores, and so on. And I think that this is going to be a major change. I think remote working is going to be, it's just going to be, now that there's so few employees, there's a lack of workers. Man, they're calling the shots. If they want to work at home, it's going to go in that direction. So you're right on that one. Our company, I had 14 employees, and when the Great Recession happened, we scaled down to 5 of us in home offices. And today I love going to the office, but I've never looked back. I know we're all in home offices, and don't have to pay high rents anymore. And I think that, but for larger companies, there's still a lot of them are still mandating that workers return to the office. But overall, I think the workers would call the shots, and that's going to happen more. And then they can live like in these tertiary markets that are, not polluted and nicer environments. Yeah.
I've seen some questions too, James. Thanks for letting me ask mine.
No, absolutely. So a couple of things for you. And I know we're getting here up to 8 o'clock. So Nicole asks, do you have programs for mixed use, residential and commercial?
Certainly.
Different Nicole, by the way.
Oh, okay. Sorry.
Yes. Yeah, actually. Okay. So, banks certainly and credit unions certainly like mixed use. Fannie Mae, Freddie Mac, FHA, multifamily will allow, let's just say approximately, I'm going to lump them together because of time, approximately 25% of the square footage and or income of the commercial space to be in, office or retail, and the rest be in apartments, residential. So they don't really, the rates are pretty much the same. So it's just that what banks are looking at really carefully right now for mixed use properties is the quality of the tenants. Do they have more than one location? Do they have, do they have a good credit rating, as a business, and so on. They're actually checking out the tenants more closely, and, they're looking for, tenants that are going to be there long, through recession, they can make it through. Yeah. And also that have, more than 2 years certainly left on the lease.
Okay, great. Let's see here. What do you think has to happen? Well, get your crystal ball out. Okay. What do you think has to happen economically for cap rates to decompress?
Uh, that's really a good question. And we have seen that, by the way, not as much in multifamily, but for sure during recessions, cap rates have decompressed, property values have come down. Not, I would say, self-storage, industrial, and multifamily have been, and also mobile home parks have weathered recessions incredibly well, but not the other sectors, the other food groups in commercial real estate. But as far as, it really is also based on supply and demand to some extent. If you're in areas where there, in so many larger cities, there's all the infill lots have been taken already. There's just very little, and they're not expanding the urban growth boundaries. So, and because of that, there's just not a lot of land to build on. But with more new construction in multifamily, you'll see that when there's a lot of, like I've done, there's some communities that I've done a lot of lending in, like Boise, Idaho, which has the highest prices now, but I've been lending there for so many years that I remember when they had so many units coming on, new construction, that cap rates did decompress, maybe 15 years ago or something. It was a long time ago, but so that can happen, but it's just that while there is low supply, and okay, we're also having, because people have just tanked in the stock market. If this is just a small tank, but if the stock market continually tanks for a while, more people are going to take their money out and want to invest in real estate. Doesn't that make sense? Yeah.
Right. No, yeah, it makes sense.
So, and that's going to create, keep the cap rates higher. I'm sorry, lower. Yeah. So,
and I don't know if this is actually happening in Portland, so this might be apropos, but someone is asking, with the discussion of rent control in certain cities, are lenders looking at that? So if it's a regional bank that maybe is out of Philadelphia and you want to buy something in Baltimore, but there's talk of possible rent control, will they take that into consideration, or they're just looking at what's going on today?
Yeah. Okay. So we're based in Portland, Oregon, and we do have, the state of Oregon does have rent control. And it's something we never thought we would see because we don't even have a sales tax.
We can hardly hear you right now.
Sorry.
That's great.
Okay. Thank you. Anyway, in Oregon, we don't have a sales tax, but we do. I never thought I'd see rent control, but we do have it. And initially, there was a tightening because they knew it was coming, and it takes a while for it to enact. So, but to begin with, and also because rents are so high already, it's not going to be an issue for a while. So you probably have a year to a year and a half of, where lenders are going to be fairly comfortable with where things are today. Before, once they know what the rent control is going to come in, then it's just that, then they'll factor that in.
Okay.
The future.
Can you talk for a couple of minutes about term sheets, what they are, what they include, and are lenders sticking to them, or are they changing things at the last minute?
Very good question. Oh boy, that's a really good one. And I'll tell you what, lenders are human, and they're salesmen, just like car dealers and whatever. In my book, I give a good parody on car dealers, how lenders are like salesmen. And what it really gets down to is that they can actually write up an LOI or a term sheet that actually is going to be more favorable than what they actually produce. Now, what we have is 3 stages. We have of something in writing from a lending source. The first is a term sheet where they're just going to put on writing so you could see what the terms are. We're talking about loan to value, maximum loan amount, debt service coverage ratio, occupancy, and so on, net operating income, and so on. And then you're going to get a letter of interest from the lender. Now, that's what you want to do, is make sure when you get to that stage, you want to ask your loan officer, has this been run by whoever is going to approve the loan? The reason Apartment Loan Store, my company, why we have a 97% or actually higher than that rate of closing our loans is proposed is we make sure that that the credit manager, whoever's going to be approving the loan, looks at the entire submission file. It's going to take sometimes an extra week for him to get to it, but that way we know that that this is going to stick to the wall. And so, term sheets, by loan officers, quite often, by the time you get to loan, sometimes the loan approval, what they're going to do is by the time they get the LOI out, letter of interest, it's going to be maybe a little bit more conservative. And quite often, if you have not had the deal run by whoever's going to approve it, the actual loan approval will be less than what you thought you were going to get. We are seeing that.
Okay. Is there a way to lock a rate in?
Well, there's, the majority of commercial loan rates are not locked until either the loan is approved or documents are drawn. Community banks, for the most part. If we're talking about credit unions, they have so much money to lend, and so if you compare it to deals, that they can certainly lock a rate. If they quote you a rate, they can stick to it. So community banks will do that as well. A majority don't, because also a lot of them, if they have a lot of their own money, they can do that because a larger bank can certainly do it too, but they have a tendency not to. If they have a lot of money of their own, then they don't have to worry about borrowing money from other banks or the feds and paying it on the short term. So they can also, lenders, I don't have time to go into, but lenders could also if it's a larger deal over $1 million, they could also purchase a swap, which can actually allow them to lock a rate. And they're going to, we're seeing a lot of regional banks, larger banks that lend in multiple states, and they can actually, with your 1%, purchase a rate swap, and they could take the risk of locking your rate for 60 to 90 days. So, but otherwise, Freddie Mac, you can lock the rate at application right now, and a few other programs too. But I have to say the majority of commercial loans are locked at loan approval or when docs are drawn. Yeah.
Okay. So, and then we just got one question left here. So, so when, if I understand this correctly, when someone is starting to, I'm going to paraphrase here. So whether it's somebody that's just starting out, or somebody that's getting into something bigger, right? So maybe they've had 30 units and now they're getting into 80 units or something like that, or they're just starting out. What do they do first? I mean, do they come to a mortgage broker and go, okay, tell me what I can afford so I can go out and find a deal that fits what I can afford? Or do they just go out and find a deal and then try and come to you and go, okay, how do I make this work? What's the best, or is there a best way to do it?
Okay, so what I'm going to tell you is two answers, and this is a really good one. It's one of my favorite things to talk about. Okay, so the first answer is the conservative answer. It's what most people will do. And okay, so all lenders for that matter, if they're looking at experience, they're okay with you getting a second property that's a little larger than the one you already own. But if you're going to be going from 30 units to 80, that's quite a swing upwards. It takes much more management. It takes a higher skill. Keep in mind that even if you have professional property management, that they're overworked. And if you don't manage your property manager, you could, you could get in trouble. So, right. So lenders like to see you, if you see, what you could do is bring in a partner that has that, 80 to 100 unit experience. Now, what I'm going to tell you though, is that I've had borrowers who just didn't know they wanted to start big. There's a great story in my book about Kelly Fabros, an LAPD officer who did not know she could not afford a $6.8 million apartment building. This was in 2004, but she knew that she could raise investors. She had taken a course on that, and she got the price down, and she did a bunch of things, and she did it. And I could tell you dozens of stories like that where people have bought, out of their league, out of what they would look like they could do, because of one reason and one reason only: they just didn't know they couldn't do it.
Right. It's amazing how that works, huh?
Yeah, it's amazing.
Actually, those are, I think that's all the questions. So, Terry, how do people get in touch with you? How do they get your book? What can you give us in terms of contact information?
Okay, certainly. Yeah, just you can write down apartmentloanstore.com, and you could you could reach me there, or you could also let's see. Yeah, and also, yeah, that's probably the very best place. Just apartment loan store, and then also, yeah, my book is on sale right now on Amazon. It's 30% off, I believe. And
What is it called? Can you tell us the title again?
it's the Encyclopedia of Commercial Real Estate Advice. It's published by Wiley. They do the Dummies books.
Okay, great. I actually bought Terry's book. It's enormous. It's like 500 pages long. So I think I read like the first 100, but it really is a pretty good source. You don't have to read it from front to back, kind of like what I'm doing. It's nice to be able to just say, okay, what about this? And go to that certain page and look it up. And obviously there's lots of great courses out there. We have one, other people have great courses. So I would encourage you, whether you're new or have been around for a little while and are growing, try and get the most knowledge that you can. You can get burned, and it's a lot of money. So the more knowledge you have, the better off you will be. Terry, this has been awesome. Thank you so very much for taking the time out of. Well, let me make everybody jealous. What's the temperature down there right now?
Well, I think it's probably around 78 now. Actually, it's just more. It's getting cold. In fact, if it gets down to 75, I have to put a sweater on.
Nice.
So,
I just walked my dog. It was 19 degrees outside.
Yeah, I'm in the Dominican. My wife and I have a winter home in the Dominican Republic. So,
very nice. Very nice. Well, that's what you can achieve when you get into multifamily, right?
Absolutely.
All right, wonderful. Well, listen, thanks so much again. We appreciate your time very much. We'll send this out to everybody. We'll email everyone Terry's contact information, the links to the YouTube if you want to watch this again, or if you only got to watch part of it. So a lot of people got in here a little bit late. You can go ahead and watch it on the YouTube channel. But thanks again, Terry. It was wonderful to talk to you.
Thank you. Okay, thank you,
Thank
James.
you, Terry.
Thank you, Nicole. Thank you, everybody. It's been fun. Thank you.
All right, have a great night. Bye-bye, everybody.